Good afternoon, everybody. Welcome to the Beresford Booth weekly webinar. Today, I'm joined by my colleague, Per Oscarsson, and we have a special guest, Mitch Brewe from RBC right here in Edmonds. And we asked Mitch to come on and talk about maybe a couple of questions that his clients are asking as we get towards the end of the year, and how those tie into estate planning needs. Mitch, one thing we had talked about that previous to this that I really had never thought of was converting IRAs to Roth IRAs, and how that can assist clients who maybe are selling businesses or in other ways.
Yeah, no, absolutely. Well, first off, Linda and Per, I just want to say thanks for having me on. It's an honor to be part of the Beresford Booth, the webinar series. There's some great content that I've gone through this week, so I'm excited to be a part of it. And yeah, no, you raised a great question. So as a financial advisor with RBC Wealth Management, we work with a lot of clients doing investment management, but then also retirement planning and business planning. And so when we look at a client's retirement plan, and we see traditional IRAs or 401ks or other large qualified account balances, that it kind of sticks out to us. Excuse me there. Sticks out to us that there might be a potential benefit of a Roth. It's called Roth conversion, and how that can tie into estate planning is you pay taxes kind of on the front end, but then the Roth IRA is a vehicle that has tax-free growth potential, tax-free distributions, a little bit more flexibility for clients. There's no RMDs, required minimum distributions, and it's also, I think the main point is that when you have assets in a Roth IRA or Roth account compared to a traditional IRA or a tax-deferred qualified account, that asset passes on to beneficiaries with a lot more tax advantages. You are able to pass on assets to your heirs with tax-free, essentially, income and growth potential. A traditional IRA passes on to heirs, and currently, there's a decedent rule where you have 10 years to withdraw those funds, and they become taxable income to the beneficiary. So,
taxable as you withdraw, as they withdraw them.
Yes.
Okay.
Taxable. It becomes taxable. Yeah, correct. Sorry, taxable income to the beneficiary as those assets are withdrawn, and the IRS says you have a 10-year window, and so if the beneficiary is in high income earning years, say they're in their 40s or their 50s, they may be in a high tax bracket. And so withdrawing funds as they're required to by the IRS from a decedent traditional IRA adds to their taxes, adds to their tax bracket, might bump them up a tax bracket. That same beneficiary inherits a Roth asset. There's still a 10-year window, so they still have 10 years to remove funds from that account, but it's tax-free. So that's not counted as a taxable income in that year withdrawn. So, and we use that strategy, and it's not a strategy for every client. It's very, specific to a client situation where they are, in their own financial planning and estate planning. But it can be a great way to pass a really good tax advantaged asset to beneficiaries down the line.
And
That's
so
go ahead.
Go ahead, Linda.
Oh, that's a good point to make for because as you said, every client has a different makeup of their portfolio of their assets.
Yeah.
But there are some clients who are what we call IRA heavy, or a large portion of their assets are in that retirement account. So their beneficiaries are going to be, or could potentially be, hamstrung by that 10-year payout with an immediate tax hit.
Yeah, no, it's and I use a lot of examples when talking with clients, and it's just anecdotes are great, right, to kind of get a point across. So an IRA heavy client or qualified retirement account, heavy, individual, say they have a lot of money in their IRA and then they retire. A good example would be we had a client who sold their business and they had a lot of retirement assets in a traditional IRA and traditional 401k, also in some deferred compensation that had not been taxable. Now, the year after they retired, they came down into a very low tax bracket. They went from paying the highest tax bracket for the last 5-10 years to being only some rental income and a little bit of interest income from their portfolios. And so they had the opportunity to convert assets from a traditional IRA to a Roth IRA in those years where their tax bracket was lower. And so, working with a CPA and a tax professional is always advised when doing something like a Roth conversion or even gifting strategies, things like that. And we work, try to work closely with those tax professionals so clients understand the implications. But the idea of taking advantage of those potentially low tax bracket years to convert assets from a traditional IRA to a Roth makes some sense.
And is the conversion to a Roth, that's something that could be done anytime during the year, but maybe you can't even make the decision whether to do it if until maybe the end of the year, or it's looking like, gee whiz, this would be a great year to do it, let's do it. So it's not necessarily just limited to an end of the year plan. It's something that could happen at any time.
Yeah, you're absolutely right, Per. So, when you convert assets from a traditional IRA or traditional 401k to a Roth account, those dollars that you convert then become taxable income in that year. So you make a good point where you might have a pretty good understanding of your taxable income towards the end of the year. Say we're in November or December, and you have a pretty good accounting. Maybe you've worked with your CPA, maybe you do your taxes yourself and you understand, here's where my income is right now and here's what I might be able to afford to convert. So you can do that kind of in one lump sum at the end of the year. That we see a lot of clients do that, and we're having a lot of conversations with clients around that right now. But we also have clients who might make it an ongoing conversion. You make contributions into a traditional IRA, and then you might convert monthly, right? So there are strategies around Roth conversions you can take, but again, making sure you understand your tax bracket, you worked with your CPA or tax professional, so that you're not surprised, by any taxes that you might pay now to get the advantage of that tax-free growth in a Roth IRA.
And so the conversion, if I just heard you correctly, you don't have to convert the entire IRA at one time. You could convert it, maybe take half because it makes sense, and it's not such a big tax hit by taking half of your IRA and creating a Roth, and then maybe doing the other half over some period of time after that.
Exactly right.
Okay.
You're exactly right. And so called a partial Roth conversion. And you might consider, I'm in this tax bracket currently, and I'm willing to stay in this tax bracket, but I'm not willing to jump into the next tax bracket. For example, 34 to the next, 24 to that next tax bracket. That's a big jump. 34
right.
to 24 to 32, right? That's a lot of tax. So maybe you want to stay in that bracket or stay in that 12% tax bracket, whatever it is. So you can convert a portion of your traditional IRA or your qualified retirement accounts into a Roth account, and then tax on those dollars. And then one thing I think is just important to note, more about the mechanics of a Roth conversion. There are certain restrictions with Roth IRAs. So once you open up and fund a Roth, there's 5 years that you have to have the account open before you can withdraw funds with that tax-free growth benefit. So there's a lot of considerations looking at your time frame for how long you want to be invested. Your overall goal of the Roth conversion, is it to save a little bit on taxes? Is it to try and pass on tax-free growth to beneficiaries, right? So there's multiple things to consider and understand before you kind of go and employ this strategy. And I think that's important to talk to your financial professionals or CPA about beforehand.
Mm-hmm.
I think that's why it's important, and we always stress this in our side of the business, of working with as a team, with your financial advisor and your tax accountant and your estate planning attorney, because we all have areas of specialization and we are familiar with other areas, but having those three experts all on the same page and talking to each other, I think is important. The other thing I think some people start to think about as we get to the end of the year is making a charitable contribution, and maybe in a way that might help them reduce their current income tax. Maybe they're trying to reduce their taxable estate. As everybody knows, we have a estate tax here in Washington state, and the threshold for that does not change much. But the federal threshold next year is set to go up to almost 13 million. And for a couple, that's 26 million. So are there any advantages of looking at charitable contributions as we get towards the end of the year, especially in light of the fact with what's going on with the stock market and potentially making gifts of assets at a time when they are sort of at a lower value?
Yeah, that's a couple great points. I think that the Washington state exemption, like you mentioned, is, it's about 2.2 parity. It's 2,193,000 is the exact number, but that's not changing much. While that federal exemption is drastically higher. So there's some kind of arbitrage you can do there with gifting, and Perry, you talked about it in the last webinar with gifting to fractional shares of an LLC, and obviously we think before you kind of look at these strategies of gifting, oftentimes clients will come to us and they'll say, well, I want a gift to reduce my taxes, or maybe they've read something where it's a good time to gift, or it's a good time to make a Roth conversion. And while it very well may be, we think it's important to stress creating a plan, whether it's working with your estate planning attorneys, whether it's working with your financial advisor or your accountants, having a little bit more holistic plan, because while it might be a great time in general to make a gift, it might not be right for your overall financial plan as you look forward. So very much say make a plan first, and then with gifting too, it's make sure that gifting aligns with your values. I think that one of the best things that I love about my job is working and seeing how generous people can be and families can be in supporting causes that they are passionate about, or supporting family members, right? So there's kind of the two routes of gifting, and I can touch briefly on each, but gifting to family, and then looking at that state exemption, and then gifting to charity. When gifting to charity, you have various tax deductibility depending on what type of assets you gift, and also the way in which you gift those assets. And so generally, and again, these are general numbers, and before you make a gift or base any gifting on these figures, I would suggest talking with your tax planner or accountant. But you make a gift of cash to a organization, you have about deductibility of that gift in the year about 50% of your adjusted gross income, right? So, and there's different vehicles, foundations have a little bit different levels, donor advised funds have a little bit different levels. So, you definitely consult a CPA or your financial advisor, but you get to deduct up to 50% of your adjusted gross income when you make a gift to a charity. So in years where someone might have a large lump sum pension payout or deferred compensation that's coming due, making charitable gifts in those types of years can help reduce your adjusted gross income. you have a deductible, gift there. But then you look at gifting of stock and other investments that you can make as well. So you can gift cash, or you can gift, say you bought Microsoft. We have a lot of clients who being from the Northwest have Microsoft that they bought maybe in the early 2000s or what have you, and they paid $1 and now it's $250, right? So there's a large capital gain associated. If they were to sell that asset and then gift cash, they have to pay capital gains in some instances. So you can choose to gift appreciated stock or investments. So if you gift those investments, typically you can deduct up to 30% of your adjusted gross income. So it's a little bit different level than gifting cash, but it helps you maybe avoid capital gains of selling the investment, and it helps you just support those charities and organizations that you want to do with a investment asset that has potential price appreciation.
I think that's important for our clients who talk about gifting. Is there's a multitude of reasons, but tax savings, I think, is a benefit. And I agree with you wholeheartedly that especially gifts to charities and or to your family need to align with your present circumstances, but also your values.
Right.
And I think it's sort of a win-win for
Right.
everybody. So is there any particular tie-in to the current market volatility, if you will, or particular things that people might have an opportunity to do now that maybe weren't as favorable, say, 2 years ago when interest rates were really low and the stock market was potentially, more up than we are now?
Yeah. So, good question. With charitable gifting, you make a charitable gift and you get that deduction, and in some cases you can, say you make a large gift. You look at sometimes people will donate buildings to universities or whatever it is. You can carry that deduction forward, but you get a deduction, right? It does not reduce your federal exemption, gifting exemption, estate exemption. So it's just a gift, and it doesn't reduce that level. But when you look at gifting assets to family or other beneficiaries, that's really when you kind of look at what are the effects of this gifting on my estate, and is it a benefit now when values are a little bit more are lower? You look at the stock market in general, and down around 20%, depending on which indice you look at. So you're gifting a asset that's 20% lower in its value, with the hope that next year, years in the future, it will recover in price. So you gift an asset to a family member or a beneficiary. The value of that gift at the time of gifting is used. So you can gift, as Per mentioned last week, this year, 2022, $16,000 to an individual. And if you're a married couple, you can essentially double that. So you gift $32,000 and you don't lower your exemption. But what if you wanted to gift 50 or 100? Then you have to file that gift tax return. So, and then it lowers your federal exemption. So when you gift assets a little bit lower in value, you're essentially giving the potential for recovery of that investment asset outside of your taxable estate. Similar to a Roth conversion, you might move investments from your traditional IRA at lower values to your Roth IRA with the hope that recovery happens in a tax-free growth investment vehicle. You're just hoping that the recovery of the gifts that you make to family happen outside of your taxable estate. So you look at it, and again, you have to have a gifting plan. We really stress having a gifting plan and understanding kind of what your goals are with the gifting, but you gift a little bit lower valuations, so less of your federal exemption might be used, and the recovery happens outside of your taxable estate, potential recovery of an investment.
That's a good point.
Yeah.
Yeah. Well, and what we also want to emphasize is that, as always, we're talking in generalities. We're not here to give legal or
Right.
financial or tax advice, but
Absolutely.
I think you bring up a lot of good points for people who maybe have had some sort of financial event occur this year, that it might make sense to contact their financial advisor or their estate planner or both, to see if there's
Yeah.
anything that can be done before the end of the year.
Yeah, yeah, and the one piece I think, and you touched on it early in the call, and then Per touched on it last week, is that federal exemption level. And right now it's historically high, and that's because of the Tax Cuts and Jobs Act in 2018, right? So when gifting assets to family above that annual gift tax exclusion of $16,000, which next year is scheduled to bump up another $1,000 to $17,000. So if you're gifting beyond that, you're using up your federal exemption. Now, the federal exemption is pretty high right now, so as long as it makes sense in your kind of overall plan, it might reducing that federal gift exemption might make sense. But there's and Per, we talked about on the phone last week, and Linda, we as well, the potential for that exemption to sunset the Tax Cuts and Jobs Act, and that federal estate tax exemption or exclusion could lower in 2026. So it would sunset 2025, and it could lower in 2026. And so gifting now, if you're making large gifts, or if you're looking at your estate and think, right now I might have a lot of Washington State estate taxes, maybe some federal estate taxes. Making a gift in the next few years, if it aligns with your plan, there may be some advantages there before a potential sunset of the exclusion, estate exclusion. Again, we tell clients all the time, we can't forecast the stock market, we can't forecast interest rates, and we can't forecast tax legislation or what Congress or the government's going to do in terms of these types of programs. But as it's written now, we look forward and say, okay, here's what we know, and here's how we might plan around that.
Yeah, that's a good point. There's been a lot of talk about that sunsetting of the estate tax, and there is just no way to tell what's going to happen. So you have to plan basically right now for what you have. Per, did you have any more questions for Mitch?
I just had the one that strikes me is, I know that there are an awful lot of different types of investment vehicles. And we talked about, you could, a lot of these, like the Roth conversion, you could do any time of the year.
Right.
Are there any that make a lot more sense at the end of the year that may not make as much sense earlier in the year? So, if you're doing something in February, this particular vehicle, whatever it might be, and I think we talked a couple of weeks ago on the tax loss harvesting, which probably makes more sense when you've had the whole year to see what has happened. Anything like that that may be much more useful in the last couple of months of the year, or if you put off your planning the last week of the year, then if you'd done it at any time in the preceding 10 months of the year.
Yeah, I think you bring up a good point with the tax loss harvesting, and that gets a little bit away from the estate planning, but which is okay. We deal with we talk a lot with clients about being strategic in this year, where you are currently, and then
right, forward
thinking 5, 10, 15 years, right? So you want to be kind of having a foot in both camps, right? You want to be thinking about
the tax loss
today, where you.
I'm sorry, the tax loss harvesting is more looking at your income tax for the year as opposed to your estate potential impact on your estate going forward.
Exactly right.
Yeah.
And so, if you had, like I mentioned, the stock market has taken a pretty good hit this year. So if you had non-retirement, investments, say, that's share of Microsoft, and you had a tax loss, an unrealized loss on that investment this year, you could potentially sell that investment and use that loss to offset capital gains from other sources. You're selling a house or you're selling a rental property. You can offset capital gains there, or you can offset capital gains from the sale of other stocks or from the sale of art. We use art. It's actually kind of interesting because you sell a long-term capital gain on a stock, generally 15% to 20% is kind of that maximum that you could pay in capital gains. If you have a capital gain on a piece of art, you actually can pay up to 28% in capital gains. So, it's little nuances that you can use your offsetting your tax loss to offset capital gains, or up to $3,000 of taxable income in the year. So if you sold an investment at a loss, maybe you sold an investment that in a company that wasn't doing well and you reinvested into another, you took that tax loss, you could offset some of your income, $3,000. And if you don't use the rest of that tax loss, it carries forward into future years. So you could offset $3,000 next year. You could offset $3,000. So you use up that tax loss as you move forward. So it's something that you can do strategically when the market's down. But again, I talk about it as a kind of one-off. But none of the things we're talking about, I think, are in a vacuum. You very much are part of kind of a more holistic plan that makes sense for you and your family or your business.
Mm-hmm.
Yeah, those I think are very helpful ideas. I think the note we would leave it on is that you should, if you have any questions, contact your financial advisor or your estate planning attorney or your CPA. And Mitch and his group are right here in downtown Edmonds if anybody needs some questions answered. So I want to thank you, Mitch, for joining us. We're glad to have you here. And maybe we can have you back on during the beginning of the year. Now what to do for 2023.
Hey, you can have me back on when the markets are up and we can talk about things to do then.
Yeah. Great. Thank you again for joining us.
Yeah.
Great.
Thank you, guys.
Thank you, Mitch.
Have a great day, everybody.
Bye, everyone.